Buyer's agent's checklist. Today we're going to go through the due diligence checklist, which happens on each and every property that we review here at the buyer's agent level here at Ripehouse Advisory. And I thought it would be helpful to walk people through step by step why each check is there and kind of what role it plays, and also at the end have a bit of a summary on the filtering process that actually goes on behind the scenes. So guys, if you're new to the channel though, my name's Julian. I'm the head of strategy here at Ripehouse. And I guess to walk you through from a high level here, so we're about to go through the checklist of what we perform on a property once it's passed a bunch of our other checks before, and I'll walk you through the rest of those other checks as we go along. And I guess I'll give you a bit of context as to why we go through each check as we go along. So when we start at the bottom, we've identified a property, it's passed our location, street, etc. At this point, we're individually inspecting the property itself. And the first part that we check is the property at least 400 square meters or more. Now, some people like to chase more land, etc., etc. For us, though most of our acquisitions are somewhere between 500 to 800 square meters, there is plenty of data and evidence to show out there that 400 square meters is sufficient, particularly at the moment as the average land size continues to get smaller and smaller as time goes on. We're seeing a lot of these new home areas where the average land size there is around that kind of 350, 380 range. So for us, 400 square meters, there can still be a lot of the value tied into the land. So 400 square meters is the bare minimum that we want to purchase. So if it's $399, that's a no-go for us. We simply move on to the next property. The next one is the property a suitable land shape. So for us, we want to be buying property that is a regular shaped block, doesn't always have to be perfectly rectangle or square, but what we don't want is a really kind of weird shaped block where we're paying for something where the value is typically in the land, but we're not able to utilize that land component at a later date to value add. So thinking whether that's a subdivision in the future, whether that's adding a granny flat in the future, essentially that weird shape with wasted land, you're going to be paying higher council rates on that each and every year, and that higher land component, particularly if it's wasted, essentially will be compressing your yield each year as well. So that is a big check for us. And then no significant gradient or slope. For us, it's about a meter or so in terms of the sloping of a block. So the reason that can be a few. So if you've got too much water runoff, can lead to erosion of the soil, moving of the property, but more so, it's also going to have issues on your development costs moving forward. If you do later on want to purchase a property that you want to value add in 10 or 15 years, again, by doing a knockdown rebuild or a build out the back or a granny flat, those properties with significant gradients or slope will typically come with significantly higher construction costs. So again, we're all about controlling the risks and risk mitigation here. So properties with significant gradient or slope get removed out of the equation as well. We then go into properties that are in rentable condition. So whilst we are pro doing renovations, or at least minor cosmetic renovations, we are not interested in properties that are going to need a complete overhaul. Like, we want really kind of easy to rent, get it out the door, can just light painting, flooring, etc. So it's not going to be in a dilapidated state, so those properties get pushed to the side. We're trying, if we're buying affordable properties priced between that, typically speaking, $300,000 to $600,000 price point, it's not in our best interest to go out and spend the next 6 to 12 months to get this property up to scratch. You're losing rental income, rising costs, rising labour. Those things are just, again, risk factors which we do not want to take on. The next part is whether the floor plan's normal and uncompromised. So this one is a little bit subjective, but again, the whole purpose of this spreadsheet is we want what I call a plain vanilla property. We're not trying to pick a property that is really hard to rent, really hard to sell in the future. We want this to be, I guess, desired by as many renters and as many home buyers in the future. So we don't want to be buying any properties with weird floor plans. So though this is a little bit subjective, we just don't want any weird floor plans. And the same thing kind of ties there on a swimming pool when we get to that level. Yes, might be great if you've got kids and you're really active and you want to be able to jump out there every summer, but you're renting this property out. Now, from a renting perspective, you might get the 1 or 2 tenants who are happy to pay for that pool bill every week for the maintenance that needs to happen on that property, on that pool, I should say. But again, for me, that's a cost. It's a sunken cost. Again, a lot of the time, the value on property, that vacant land sitting at the back of the home, is far more appealing if there's not a pool there, because a potential buyer is going to come in there and go, well, hang on, maybe I'm going to add my ultimate workshop back there. Maybe I'm going to add a granny flat. Maybe I'm going to do a subdivision, all those kind of things. The pool actually makes it more limiting, as well as the rising costs associated with having a pool. That is a no-go. We move on to off-street parking. So this is a really big one, particularly for rentals. You might have, multiple adults living there. You might have older kids. So there could be 3-4 cars living on a premise, no difference from the average home. So having off-street parking is a big one. So again, because that puts off potential buyers. It also puts off potential renters. If you're looking for a property and you've got 2 or 3 cars living at the house and there's only 1 or 2 parking spots and there's no place to park on the street, those properties get overlooked. So same premise happens to us when we're trying to find property to purchase for clients. So that's a bit of a no-go for us as well. We then move into traffic. So there's a fair few to unpack here. So major arterials, you're backing onto a major highway. You've got noise pollution, which is a big one. You've also, think of it, you've got pets, you've got kids, you're not really wanting to have the ability to potentially run out onto the road, etc. So that is an absolute no-go, though it is great to not be too far from a major arterial. Backing onto it is definitely not a desired factor for most people. You don't want to be laying there in bed at night and you're hearing hoons racing up and down the street all night. It's a no-go. So we move on from that one. Same premise applies to a 4-lane or a busy road. Again, families typically don't want to be having that driving up and down the front of their home each and every day. Then we've got one-way streets. So again, kind of like the parking issue, people want to have that flexibility to be able to turn in and turn out. They don't want to be able to have to U-turn and having restricted access to the property. So that's a no-go. We then move down to bus stops. So bus stops, think about you've got your home, but you've got a bus stop sitting directly out the front of your house. And though this may sound a little bit stereotypical, you don't really want people getting in and off the bus out the front of your home. Doesn't always bring the best clientele getting off as well. So that's an undesirable factor, which we want to push to the side. Those kind of things can impact your days on market a little bit as well. These two are kind of closely related. Not in front of a roundabout or a T intersection. The big reasons for that is those types of properties, we've probably past them a few in our own lifetimes before, where you drive past a house and a car's gone through it because some local hoons decided to not slow down or try and be Vin Diesel and Tokyo drift through the roundabout, and instead he's gone into the front lawn or he's gone to the front of the house. So that's one, bit of a risk factor there. 2, it's more traffic going past those points. If you've got the bedroom or the living room at the front of that home, you're going to get light shining through. So again, anything that is going to reduce potential renters or potential buyers on the property, we are not interested in. So we move away from those. And same thing applies to being at the front entrance of a school. So being close to schools and in good school zones is absolutely important. Proximity to utilities and amenities is a big driver on the R score. However, being directly out the front of a school, if you've got kids, like I do, you go to school pickup 9 a.m, 3 p.m. every day. There's up to 50 to 100 cars out the front, kids going in and out. You don't want that at your home. You can't even park at the front of your own place a couple times a day. You've got your school bell, you've got the kids walking past, there's extra noise. That's a no-go for a lot of people. So we move on from there. Then we've got high tension. So these are more risk factors we're getting into now. So high tension power lines, and also what's not in here is power transformers. Being too close to high tension power lines and power transformers, there's a couple of risks here. So can affect your insurance premiums, but the big one also can impact your finance. So your finance provider may need you to have a bigger deposit to cover the risk associated with that home. So instead of you being able to come in with a 5 or 10% deposit, they may require you need to put down a 20 or 30% deposit, which if you're living in the home, you might go, well, that's fine, I'm going to live there anyway. Well, that's okay at the beginning, But if later on you want to extract equity from your property, you've always got that cap stuck on your property. So if you are going to extract equity, you can only go up to that 70 or 80% barrier. You've got restrictions. Again, we want a property that's easy to sell and rent, so it's appealing to as many buyers and renters as we can. That's a no-go. Then we've got the threat of new subdivisions and land supply. So that extra supply, pretty common one. Extra supply will typically stagnate your growth. If you've got cars coming through, you've got a limited edition car, but all of a sudden they just start printing it out in the thousands, well, your car's no longer going to be growing in value. So same concept applies to property. It's really that land scarcity that really builds and drives value. That's why those inner city locations will typically outperform your outer regions as time goes on. It's only once those outer regions have missed their landfill do they start to really grow at the same kind of rate as those inner areas. So sometimes people get sucked in to thinking that, buying on a street which has got subdivision potential is great, but if you can subdivide, most likely so can your neighbour, so can your neighbour's neighbour. So that's, again, that threat of new supply isn't always vacant land. It can also be what's within the street as well. Then we move on to childcare centres. I sometimes get fun, and why is that not important? So if you're living right next door to a childcare centre, kids are pretty noisy. The kids go out to play during the middle of the day. That can be undesirable to people, particularly if you're working from home, just that noise restriction. So being just a little bit away from that is more ideal. And then we've got abattoirs. Also, I should preface this on there, which is in line with that as well. As also refuse facilities sits in line with that as well. They come with a smell. People don't want to be living too close to those types of properties. Then we've got cemeteries, either located directly across or nearby. This is a huge days on market indicator as well. That's going to grossly reduce the pool of potential buyers and people wanting to rent it. And it's no different, supply and demand. If you've got less people applying, your days on market is going to increase, which in turn will not drive the price growth that you're looking for in comparison to other like-for-like homes nearby. Then we've got exposure to commercial properties. You've probably seen this in areas close to you. If you're too close to all the local factories, that tends to be the least desired pockets of a suburb. Your blue chip streets, typically near the best schools, typically near the shopping centres, typically near good highway or infrastructure access. It's not going to be that way in terms of commercial properties. Busy walkways, again, it's pretty similar to the noise complaints, people walking past your house making noise, etc. Then we get into zoning. So when we get into zoning, big one, kind of what we're well known for in the industry is public housing's a no-go zone for us. So we don't want to be in pockets that are littered with public housing, I should say. The reason for that is because properties that are located in public housing dense area will typically underperform in capital growth versus the suburb average by around that kind of 25% in the negative standpoint, let alone you get properties further away in those blue chip streets will typically outperform the suburb average by about 20 to 25%. So there can be a huge disparity there. Then you've got flood zones. So flood zones, we can park in there bushfire, cyclone areas, tsunami areas, etc. The big problem with those is that they come with very heavy insurance premiums. They also will come with the same premium sometimes that your high tension power lines can come with, requiring larger deposits, etc. Again, you're going to scare off investors and also home buyers. Why would I want to buy your property at a certain price point when, potentially my insurance premium is 3 times the amount of the similar type of property down the road? That's an ongoing cost you're going to have to incur. So less investors, less home buyers that are interested, less demand, less growth. Then we move on to problematic easements. So, a metre or two off the back fence or the side fence is completely fine. But if you've got a really large vacant parcel at the back, but a huge easement's running through right through the middle of it, that's probably a no-go zone for us. Also really problematic easements which are going to impact access to the property are an absolute no-go. And then we've got area-specific underlays. So, somewhere like Ipswich, old mining sites, there's mining underlays which sit there. They can impact the soil erosion, movement, etc. So again, it's really knowing those areas. So All of these checks happen on each and every single property. This is basically after the fact. We've gone through the filtering process, and I'll walk you through that at the moment. But to summarize the reason for this check, it's about risk mitigation, and it is about buying a property that's easy to rent and easy to sell in the future, because those two things in particular are going to be a huge indicator for demand. If you've got a property that's higher in demand in a certain area than another property in the exact same location, you're going to get better growth in terms of capital growth. You're going to get better rental growth as well. So it's a very, very, very big part of what we do here as a business. And in terms of, I guess, what we cover off from the filtering standpoint, if you haven't seen this before as well, because this will give you a bit more of an oversight. So we start at the very top level here. We start at every single suburb across the country. It's always going up as new developments come through. Starts at about 15,300 at the moment. We then have our proprietary blend algorithmic score, which is an indicator out of 100%, driving which areas are more likely to grow at high performance growth than others. Like any performance bell curve, we're focusing on the top 10%, which leaves us with 1,500 properties to work our way through. They then get manually verified by Jacob and the research team. 80% of them fall away here. They're at all different price points, from as low as $280,000 into the multi-million-dollar territories in your northern Sydney suburbs. So that leaves us about, at any given one time, 230 to 270 approved growth locations across the country. That's about 1.5% of suburbs that are sitting as approved at any one time. Now, from there, we look at every single opportunity that comes through on a weekly basis. That number fluctuates in terms of season, in terms of listings coming through, etc. It'll be anywhere between around about 4,500 to 6,500 properties per week. They go through their very first screening process, where 80% of these properties fall away here. The reason they're typically falling away is either because the land component is too small, the property's bedroom configuration is not in demand. And what I mean by that, it's not just about ignoring 1 or 2 bedroom homes. It also means if we're buying an area and everybody's only interested in 4 bedroom, 2 bathrooms, then guess what? The 3-in-1s are ignored for us as well. And then the other one is properties that are way overcapitalized, overvalued compared to the core demand pricing of an area. They then go through a street sweet spot analysis, which this part here is making sure we're buying in the best streets. We're making sure we're not too close to public housing, and we're not in a pocket that's filled completely with renters as well. We want to be near a decent percentage of owner-occupiers, because owner-occupiers are the ones that typically renovate, they're typically mowing their lawns and gardens, and they're typically parking in their driveways or garage. That makes a huge impact onto your street appeal, which those properties, again, about 80% fall off at that street level. Then go through the due diligence checklist we went through just now. And as you can see, about a third of the properties actually pass the due diligence checkpoint at that point there. So it goes from 4,800 down to 92. And I would say that week there is actually a higher conversion week. So there's quite an amount of process checking and risk mitigation that happens along the way. Guys, I hope you found today insightful, giving you a bit of knowledge in terms of what happens behind the scenes and some of the high level checks we do on properties here at an advisory level. If you like this one, if you have more questions on that, please leave a comment below. It's always great to get feedback. If you're not already, please make sure you like and subscribe the video. And if you're not following me on LinkedIn, please make sure you do. We'll be posting a lot of research and reports through there as well. Bye for now.